and welcome back to the Good Investment Guide. I'm Akshita, your host, and today kicks off our second episode in this season where we are delving into the global finance topics to get the full picture. Last time, we touched on how the tension between US and China affects the world's money matters, but today we are digging deeper into this. We'll talk about the worsening US China relations and how they are shaking up the financial world. Before we get into it, let me introduce our expert for the day, Mr. Peter Lewis. Peter's not just any expert, he's a big shot in financial services. He used to host Money Talk, a highly respected radio show in Hong Kong, and he's got over 40 years of financial savvy. Peter's here to help us navigate this complex financial landscape. Peter, it's fantastic to have you on the show. How is it going today?
Thank you very much, and it's very good to speak to you all again on the Good Investment Guide. Good afternoon, everybody. Yesterday we were talking about, we started to talk about some of the big themes of 2023 that have really affected the financial markets and investment in them over the course of this year. And we focused yesterday on the US-China trade tensions. That's been a big cloud over the global economy and over global trade and also on international relations. It's had a big impact on markets in some countries as well. And it's very much an ongoing topic. President Xi Jinping has just a few hours ago arrived in San Francisco, where he's going to attend the APEC summit, and he's going to meet later on today with President Biden. And they're going to sit down and try and see if they can resolve some of the differences that exist between the two countries, which, as I explained to you yesterday, go back many, many years and are very deep and in some cases quite intractable. So it'll be interesting to see how they get on. President Xi did say today before the meeting that he would like to help China's economy improve. He said it's in the best interests of America if China has a strong economy, if people have jobs, have good paying jobs, although he made a caveat that while he's happy to invest in China, it shouldn't be at the expense of intellectual property and having intellectual property stolen by Chinese companies. But nevertheless, he's holding out an olive branch because one of the weaknesses, and it brings me on very nicely to today's topic, which is China's economy and also the fact that it has slipped into deflation. China's economy has really been weak all year, although it is going to grow maybe about 5%. Year on year. That sounds pretty good, but it does compare to a period a year ago when China was in lockdown. So you would expect things to improve. If you take that into account, maybe China's economy is growing closer to 3%, which is not so good for a country that really for many decades has enjoyed double-digit economic growth. And one of the problems of the Chinese economy is a lack of domestic demand. There really isn't the sort of domestic demand that we're seeing in other economies like India, like the United States. And in those economies, domestic demand is a very large part of the economy. China has really depended upon investment to boost its economic growth and also exports. It exports goods, it's the factory of the world, and for a long time has exported goods all around the world and built up large trade surpluses in the process. But that hasn't really helped the domestic consumer, and the domestic consumer doesn't feel any richer. In fact, he feels poorer at the moment and is very cautious following the experiences they had in lockdown last year. So what this has led to is China's economy falling into deflation. And what we mean by that is that consumer prices are now declining year on year and month on month. China's consumer price index dropped by 0.2% compared to a year ago in October. It was zero in September. So it's now sliding further into what we call deflation. And this is despite multiple stimulus measures from the Chinese government to try and get people to spend more. But in spite of that, people just aren't spending. Food prices declined the most in over 2 years. They're down about 4% year on year. Non-food inflation did rise. That was up about 0.7%. And core inflation did actually increase. So this all sounds very strange because around the rest of the world, it's been the opposite problem. People have been struggling, countries have been struggling with inflation, with prices going up and going up far too much. Whereas in China, it seems to be the opposite. So it's probably worthwhile me spending a few minutes explaining what exactly is inflation and what exactly is deflation, which, as you probably expect, is the opposite of inflation. Deflation tends to get less attention and is less common than inflation, but nevertheless, it still has a very big impact on every sector of the economy. And it also has an impact on the composition of your portfolio. Both inflation and deflation have positive and negative effects depending upon a host of factors, such as how your assets are allocated, diversified, and your overall approach to investing. So let me take a few minutes to explain about inflation and then also deflation and what impact it has on you. Now, first of all, inflation is one of the more common financial phenomena around. You hear about how inflation makes the cost of goods increase, which is really the largest impact it has on the economy. But the causes and effects of inflation go beyond making goods just cost more at the grocery store. What it also means is that a currency's value is decreasing, and that results in you having less purchasing power. What can now be purchased with what could be purchased with maybe 1 rupee can now cost 2 rupees to go and purchase. So why inflation happens, though, is a little bit more complicated. Generally speaking, inflation is a result of too much money in a country's economy. And if the rate of inflation is high, it suggests that the money supply, as we call it, is growing too fast. And if inflation increases slowly, it's typically viewed as a sign of a country's economic health. Well, of course, as we know, the money supply in most economies, particularly the United States, had been increasing up until the beginning of this year very, very fast. And that was because of all the stimulus measures that governments were taking to try and combat the COVID pandemic. So they pumped money into the system. They did it through giving households spending vouchers, as happened here in Hong Kong. It gave households discounts on loans, on their energy bills. It provided money to businesses. So there was really low interest rates and a surplus of money going through the system. So that resulted in a lower value of the currency, makes goods that are imported more expensive, and consumer confidence tends to drop during inflationary periods, which makes the average person less willing to spend money. So over the past 10 years or so, inflation stayed at a fairly manageable range between about 0 to 2.5%. But that changed after the COVID-19 pandemic, and inflation soared along with the money supply. So how does that affect your portfolio? Because if you have a portfolio of assets, you will have some where slow increases in inflation don't make too much of a difference, and other assets where inflation can make a lot of difference. And particularly if you own stocks that rely on raw materials for manufacturing, you find that these businesses often have lower margins when inflation occurs because the cost of importing those raw materials goes up. But on the other hand, hard assets like commodities, corn, wheat, gold, farmland, property tend to do well when we have periods of inflation. So what is deflation? Well, it's really the opposite of inflation. When deflation occurs, there's less money circulating in the economy, and interest rates are often higher at the time. So the value of the currency increases and the value of goods decrease. So this additional purchasing power can get consumers to spend more money. But often what tends to happen is that when you have deflation, consumers tend to put off buying things immediately because they tend to believe that they're going to be even cheaper in a few weeks or a few months' time. So what can happen with deflation is that you can end up with a downward spiral where the deflation just gets worse and worse. The central bank has to cut interest rates, which in turn lowers the value of the currency, and the currency starts to slide, and you end up into a deflationary spiral, which is what we saw in Japan at the beginning of the 1990s, and it was a deflationary spiral that lasted for at least 2 decades. It was very difficult to get out of. Now, China isn't in that sort of deflationary spiral yet. However, it could happen, and if the government doesn't do something about it to try and combat deflation, then there is always the risk that you fall into this deflationary spiral. And then it's not just prices that are going down, wages start to come down as well, financial assets start to fall very fast. Now, what we have in China at the moment is we have maybe a period of what we would like to call disinflation. In other words, really low or slightly negative inflation. And that, in effect, is what we are seeing right now in China. But nevertheless, it poses a lot of challenges because it is, again, a very difficult phenomenon to try and counter. So China's economy, I mean, it's flourished over the last few decades. We used to see growth very consistently of 10% annually or so until the pandemic. And then we started to see growth sort of decline. And now we've started to see the economy slip into deflation. And why has this happened? Well, partly it's because of the global commodity cycle. Supply chain pressures have started to ease, and there's been some declines in commodity prices. And also specifically in China, government policies have been very geared towards supporting production and particularly manufacturing, investment, particularly in the property sector, and also building a lot of infrastructure around the country. But none of that puts money into the consumer's pocket or makes householders any richer. In fact, if anything, it takes money away from them to go and redirect it towards things like infrastructure spending, which is done by local governments. So it directs money from households to local governments. So as a result, it's a big disincentive for consumers to go and spend, and instead they tend to save. And the more prices fall, the more they will tend to save, because there's no pressure other than for essentials to go out and buy expensive goods right now. And this slump in the real estate sector that we've been seeing in China has weighed very, very heavily on the economy. And that also has put downward pressure on inflation, because we're seeing house prices decline, we're seeing the price of land decline. So what does this mean for the global economy? Because we have this odd phenomenon at the moment where we have deflation, or disinflation as I prefer to call it, in China, declining export prices, and nevertheless inflation in other parts of the world. So one of the things that this will tend to do is, first of all, it will tend to export that disinflation to other parts of the world, and that comes through changes to supply chains, also problems for exporters. Exporters find it much harder to export to China when there's deflation, and you tend to see, as we do in the mainland at the moment, a lot of cost cutting, a lot of price competition. So you end up with a very, very competitive market that makes it difficult for exporters to go and compete with. We're seeing that in the electric vehicle sector at the moment, where Chinese electric vehicle makers are grabbing market share around the world because they have a very, very cutthroat business in the mainland. They cut prices to the bone, and most foreign firms can't compete with that. So this disinflationary process can be exported around the world, and it can make it very difficult for other countries to export their products over to China. And in addition, what you also get is a depreciation of the currency. The yuan has depreciated over the past year, although the People's Bank of China is doing its utmost to try and support the yuan and to try and hold it up, but roughly 2/3 of China's goods traded are transacted in US dollars. So this means that the yuan is driving down import prices in local currency terms, especially in places like Latin America and Europe. So China can export this price deflation, and combined with a fall in its trade-weighted currency, it's going to reinforce the slide in core goods inflation that's going on at the moment in other parts of the world. We just had the US inflation data, consumer price index, out overnight, and it fell further than people expected. So we're starting to see already the effects of China's disinflation impacting other parts of the world. And already central banks now are talking about the end of rate rises certainly in the US, in the Eurozone, and in the UK. So a key part of this is the housing market. China's housing market has been experiencing a downturn cyclically and structurally since about 2021, when property developers started to default because of tightened regulations on their debt limits. So new home sales now are down over 50% compared to levels of 2 or 3 years ago. House prices have also slipped, not as much as 50%, but nevertheless, they are down. Investment in real estate is falling. We just saw figures out today, which showed that once again, investment fell another 9% into the real estate sort of sector. So it could be that this disinflation or deflation in China is going to be here for a while. Now, it may be that CPI might turn positive later on in the year because of the base effects compared to the year ago, but we should be prepared that we're probably going to see at the very most low inflation in China and maybe deflation in China for a while, and that's going to have an impact on the global economy. It's going to have an impact on inflation in other parts of the world, and will slow down the need for other central banks to go and raise interest rates. They're going to leave rates on hold, and maybe next year we will start to see talk of them starting to cut interest rates. So this is going to be an important theme going forward. It's an important theme this year. The impact of deflation, the property market, China's economy. It's going to be an important theme next year as well going forward. We're going to see a lot of data which is going to be very closely scrutinized on things like the CPI, the PPI in China and in the US, and the response of central banks to that. And that in turn is going to have an important impact on markets. You saw overnight the impact of the US inflation data on markets yesterday. We saw the consumer price index drop to a 2-year low in the United States. It fell to 3.2% last month compared to 3.7% the month before. That was below what economists were thinking it was. And month on month, there was no inflation at all. It was unchanged. So that's the lowest it's been in about 15 months. And core inflation now is running at about 4%, just over 4%. Now, that is still well above the Federal Reserve's target of 2%, but nevertheless, it's down by a lot from where it was a year or so ago. So we're starting to see already signs of slowing inflation in the US. We saw huge rises in US stocks overnight as a result of that, and a huge rise in the bond market, causing big falls in US Treasury yields. The 10-year Treasury yield fell about 2 basis points. It's now 20 basis points. It's now at about 4.5%. Only last month, that yield on the 10-year Treasury was over 5%. So it's come down very, very quickly. And US stocks have had a big rally so far in November now on the belief that the Fed has finished raising interest rates. So that's changed completely the environment for stocks, because we've had 3 consecutive months where US stocks have declined, but in November that has really turned around, and the S&P 500 is up almost 10% now in the last 10 days or so, in the last 10 trading days or so. And the Nasdaq is only 9% away from a new all-time high. So it's quite possible that we could see new all-time highs in US stocks before the end of the year if this bullish sentiment continues and investors continue to believe that central banks are done raising interest rates, and we're not going to see any further rate rises this year or next year. So this is really stemming from what's happening in China and the Chinese economy. So we need to keep our eye on it. We need to watch closely what's happening to deflation on the mainland. So that's all I want to say today about China, and I'm happy to take any questions.
Thank you so much, Peter, for discussing all the details. Now I'll quickly move on to the questions. And the first question that would be headed towards you, A, would be how did the intricate dynamics of the US China trade tensions impact both consumers and producers in both the nations, even with the bilateral trade deficit showing minimal alteration? And here I'd like to quote one of the outlines that were mentioned in an IMF publication, that like what are the potential repercussions of this recent escalation on business sentiment, financial markets, and the anticipated global economic growth, considering the implications for supply chains and overall market stability?
Well, we talked about this yesterday. Of course, it has a big impact. These trade tensions have been a big cloud over the global economy for several years now, ever since really Donald Trump came into power and imposed sweeping tariffs on a whole range of Chinese goods, and then China retaliated. People hoped that when President Biden came to power, there was going to be an easing of trade tensions. But if anything, it's got worse because he has slapped bans on the exports of all sorts of technology to China, particularly high-tech technology that could end up being used for military purposes. And that has really held back the development of China's chip industry. It's also made it very difficult for businesses that operate in China. It's been much harder for them to carry on doing their normal businesses there, and it's forced them to look for alternative places for their supply chains, including India, Vietnam, Bangladesh, other countries around the region. Now we're seeing that exports to Mexico are overtaking exports to China for the US. So it's moving supply chains around the world. So it's having an impact on trade flows. It's having an impact on the economy. It's certainly had an impact on the Chinese economy, all these restrictions. So it'll be interesting to see what happens today in this meeting between President Biden and President Xi. President Biden says he would like to have more normal relations with China. He would like to help the Chinese economy grow. It's in the US interests if the Chinese economy does grow and if people have good jobs and are working and being well paid. But it'll be interesting to see what concrete measures they're going to take to make that happen. It's all very well saying we'd like China's economy to do well, but what exactly is the President Biden going to do about it, and what exactly is President Xi going to do about it to make it easier for US companies to do business? After this meeting with President Biden, President Xi is going to sit down at a dinner with around 300 business executives, CEOs from leading US companies. Elon Musk is going to be there. Tim Cook is going to be there. So this will be a chance for him to hear directly from US business leaders what they would like to see China do to make the business environment more friendly for overseas companies.
Well, that sounds really very interesting. But I have another question that connects to this, which is considering the entrenched competitive framework between the US and China, what opportunities might the United States identify to push forward its priorities in the bilateral discussions?
Well, the United States doesn't have any particular outcomes in mind for this. So it's really, the bar has been set very low. They've said quite specifically they're going to talk about a whole range of issues. They're going to talk about Taiwan. They're going to talk about the Israel-Hamas war. They're going to talk about trade. They're going to talk about economic sanctions and so on. But the US has said it has no particular outcomes in mind. Its number one aim, it seems to be, is that it wants to talk. Now, my thoughts on that are, it's all very well talking, but what do you want to come out of those talks? There's not a lot of points in just meeting every year and talking, but not doing anything. But the Americans do seem to think that talking is important. They believe, in particular, at a military level, it's very important to talk and have open communications, because otherwise there is a risk of an accident in the South China Sea, for example, or involving Taiwan, that could lead to a conflict, and that will be disastrous for the world and for the global economy. So the US believes it's important to re-establish particularly those military contacts that were severed after Nancy Pelosi went and visited Taiwan over a year ago now, and China suspended all those military sort of contacts. So that's going to be important. It's important for America anyway. I'm not totally sure what it is that President Xi wants from this, because he must know, well, what he does want is he wants to have those sanctions lifted and those tariffs taken off. But I think he must also be very realistic, and he must know that that isn't going to happen, certainly in an election year. I think what he does want to do is he wants to try and persuade business leaders that it's safe to invest in China, because they've been pulling their money out. Foreign direct investment has turned negative. The stock markets are very weak because foreigners have been selling. I think he wants to try and convince them, and this is his opportunity at the dinner, to try and persuade them that that China is a good market to invest in, and its economy is a good economy to invest in, because there are feelings among some American corporations that China right now is uninvestable. And I think he wants to try and reverse that perception in the minds of business leaders in the United States.
Well, Peter, speaking of the international relations and China's involvement in the markets and having a dominance in the sector, and US reacting to the same, there is a question that just popped up into my mind, which is like, in what ways do the export controls on advanced semiconductor technology and the investigation into French shoring impact the broader economic landscape between US and China? This question I'm asking, keeping in mind China's dominance over Taiwan, which leads in the semiconductor industry.
Well, the ban on high-tech equipment to China is designed to try and stop that equipment, that advanced equipment, getting in the hands of the military. The US doesn't mind that high-tech equipment being used for economic means and peaceful means, but it doesn't want it to be getting into the hands of the military. Now, the problem China has had is that it's often blurred the lines between civil activity and military activity, and it's absolutely true that there is a transfer of knowledge and a transfer of products between the two. So it is quite possible that if high-tech equipment is sent out to China, it could get in the hands of the military. So the US has been very clear that it's not prepared to negotiate on that, that it's not prepared to have its own high-tech equipment used to build up Chinese military capabilities. So what China has got to do is it needs to invest instead in its own technology capabilities. It doesn't have yet the advanced capabilities that the US and Europe has. It relies on importing semiconductors, semiconductor manufacturing equipment from overseas in order to develop its own domestic semiconductor industry. Now, that's what it's trying to do. It's putting a lot of money into doing that. It's made it a top priority for its economy so that it can try and catch up with the US and other countries in terms of having its being self-dependent on its own semiconductor manufacturing capacity and not have to rely on imports from elsewhere. Now, that is going to take time. although there are signs that it's happening quicker than maybe the United States and other countries thought. We saw that with this new Huawei phone that seems to have a very advanced 5G capable chip in it, which America didn't think China had the ability to develop. And that chip came from China's largest semiconductor manufacturer, SMIC. So there are signs that already maybe they are starting to catch up, but it is going to take a lot of money. And this is one of the reasons why China needs to restructure its economy, because it needs to put a lot of those resources now into developing that sector and less into infrastructure spending, less into the property sector, which has drained a lot of the fiscal capabilities of China in recent years. Now, in the meantime, it's obviously difficult for American companies like Nvidia, like Intel, to do the normal amount of business in China, because they in turn are restricted by China that slapped some restrictions on them. So the American semiconductor manufacturers don't like these restrictions and don't like these sanctions, because it affects their business into China, which is obviously their largest overseas market. So it affects both sides, but unfortunately, there's not going to be a change to that, certainly not at this meeting. There is no chance of President Biden announcing an easing of these sanctions or these restrictions. What he may do is he may look at other areas where they can try and boost trade and boost collaboration, but it's certainly not going to be at the expense of removing those restrictions on those companies.
Fair enough. I just financial landscape.
Sorry, you're cutting out there.
Please,
I can't hear you.
please excuse me for that. There was some sort of technical glitch. I'll put my question again, which is amidst China's deflation, how might India's financial landscape feel the echoes of the intricate tango between the US and China in their trade tensions, intertwining the global economic currents with nuanced implications?
Well, as I said earlier, China can export its deflation around the world. We've seen that happen before, and it's quite possible that it could happen again. It will have the biggest effect on its closest trading partners. So that's going to be the US and it's going to be the EU. They are the two biggest trading partners, and also the Southeast Asian economies, Singapore, Indonesia, and so on. They are the big trading partners for China. So if you're going to export your deflation, which comes through making exports cheaper, imports more expensive, then that's how the deflation goes around the world. So there will be a limited impact maybe on India, because India is not such a big trading partner for China as maybe the EU, the US, Southeast Asia is. But nevertheless, if inflation is slowing all around the world, it's going to be difficult for India not to be impacted. The chances are that inflation will start to come down in India as well, because obviously India is a commodity importer. So the prices of those commodities will get cheaper, both energy products and agricultural sort of products. So there will be an impact on India as well. Now, that may be a good thing for India, because the Reserve Bank of India wants to get inflation down. The Reserve Bank of India sees inflation there as being too high as well. The only thing you don't want is you don't want the world being dragged into deflation. You don't mind having low inflation. The ideal environment is to have a positive but low growth of inflation. You don't want high inflation, you don't want deflation either. But at the moment, India's in the situation where if inflation comes down further, that's going to be good for the economy, and it's going to help interest rates come down as well and stay at more sort of reasonable levels, which will help investment and help growth in the country.
Thank you so much, Peter, for answering all the questions and describing the topic to our audiences in such a simplified way. It was a true treat listening to you, and I'm sure a lot of doubts must have been resolved by now. And I'm really very excited to continue discussing a lot of these global issues with you in the upcoming episodes. Now, as we come to the closing of this episode, ladies and gentlemen, as China's deflation resonates across India's financial canvas, it unveils the intricate connections in our global economic theater. The dance of trade tensions between nations like the US and China paints a vivid picture of the intertwined destinies and shared impacts. The story is just beginning to unfold. To unravel more layers and gain deeper insights into this complex narrative, join us on Bullsmart. Our app is your gateway to understanding with the intricacies shaping our global economy. There's a wealth of knowledge waiting to be explored in this ever evolving economic saga. Once again, I'd like to thank Mr. Peter for joining us.
Thank you very much, everyone, and talk again next week.
Thank you so much, everyone.